Buddy and I, as we thought about it, we wrote this, we actually wrote a version, an academic version of this for a book about 2 or 3 years ago that was called Advances in Mergers and Acquisitions. And we were doing the mathematical side of trying to show and prove a few of these things. And we said, you know, we ought to put this in more practical terms. And that's where that little book that we laid out came from. And it really came down to two fundamental kind of concepts. One is that you've got to have a greater return for the amount of capital that you put in the business. If you can increase that return, if you can increase the cash flow off of that capital, you can increase the value of that business. The other piece that ties with that, by the way, is you can't change the cash flow, but you can figure out how to reduce the amount of capital it takes so you can play both sides of that equation. The second one is how do we change the risk profile of the business? You guys know that if you take the greater the predictability of cash flow, the lower the risk, the greater the value. And so it's really those two main levers. And so we tried to break that down into, if you will, kind of some areas of the business that you can really begin to act on. So let's talk about that for just a minute. I'm not going to go through them all, but I want to give you just a couple of highlights. One of those is the customer base. This one is always interesting with clients to talk about, is the idea that what's your ideal customer base based on that growth strategy, and how many of your existing customers fit that ideal customer base? It's interesting that you go through that and how misaligned that may be. And what that means is that if you think about your growth strategy, your pricing strategy, market position, if you don't have customers that are going with you, that are part of your customer base, that are going to appreciate that and pay for that and be solid references moving forward, you may have the wrong customers. So part of what that means is possibly culling a customer base and shaping a customer base over time, or de-emphasizing certain customers and emphasizing other customers. So understanding what that customer base is moving forward is really an interesting and one of the big exercises. Another one is that'll hit home here for many of us that do the financing side is how do we tighten the operating cycle? Basically, how do we operate the business with less working capital? And there's lots of different techniques for doing that, but optimizing working capital directly impacts the value. In fact, in transactions, one of the things that Buddy and I have said when we're talking to business owners on the sell side, we encourage them to think, if you're hiring us, we're not an expense. If we're an expense to you in the process, you've got the wrong people. We're an investment because we'll create a return. And one of the places that I would say by far is the easiest place that we get value for a client out of a deal that they're not expecting is through the working capital negotiations. Because most businesses don't have a tight working capital cycle. And being able to help position and then negotiate that is kind of a critical area. And we find that we pay for ourselves easily in that process. And then if you think about reducing risk, I'm not sure what your experiences are, but ours are, there's kind of three areas, I would say, in lower middle market companies. Number one is customer concentration. We bump into customer concentration issues all the time, and that's a detractor in itself from value in general. Now, there are exceptions to that. We have seen companies that have too many customers, and they actually need to consolidate the customer base some. It would help them, but most of the time that's not the case. Most of the time there's one or two dominant customers or three dominant customers, and that's a risk. It may feel good, or it may be that the owner has a long-standing relationship with that company and think that business is never going to go away, but we all know that over time, and particularly if you change owners, that it can happen unexpectedly. It can happen overnight. So customer concentration, one. Relationship concentration is a second one. It's where the CEO or the owner of the business has all the key relationships and has not really pushed that into his team. Well, that's a really critical risk for an outside party, whether you're an investor or a lender or a buyer. That's a problem. So addressing that is one of those areas that it takes time, but it can be done. And then third is supplier concentration. We have kind of the reverse problem, but you see where you're critically dependent on a particular supplier, trying to find ways to mitigate that. And there's lots of different strategies depending on what the connection is and why you're dependent on them. But addressing those concentrations, I would say, is the number one risk changing lever that we see in general. Obviously, there are other ones. Compliance is another one, by the way, that I find is, we did a deal 2 years ago. We sold a company, a small private company to a larger public company, and the issue they ran into is they had mishandled payroll a couple of years back, and they were still fighting with the IRS over payroll taxes. Yes, the money was important, but it speaks volumes to the management and how in tune they are with their business. And so compliance with laws is something that many times I see owners as a small business are willing to skirt. But when a big company buys you or an investor comes in, it changes that dynamic. I'd say the classic one is nexus issues on taxes within multiple states. That's probably the one we see as being one of, and many owners will say, well, I don't really have to file in that state, or we only have one employee there. Well, you know, that whole dynamic changes as soon as you bring a larger corporate or private equity in. You can get on somebody's radar screen, and the tax authorities are so aggressive. So compliance issues can be another one of those, and I'm putting in the bucket of risk reduction, and it really is. So those are our two big levers. And the way we get to those, and this is an example, what we did is we'll take the P&L, let's say what generates sales or revenues, and we'll look at the markets, the customers, the volume, pricing, and kind of go back to that question about do I have the right customers. But another area that we look at and we see many times is pricing. We'll have a client that has been running their business, they're comfortable, they're generating enough cash flow, and they don't want to take the risk of a price increase. Well, if you follow that on and you say, well, wait a minute, why do you feel there's a risk in increasing the price if what you're offering is really competitive, and you want a buyer or an investor to take that risk? Why should they take it if you aren't willing to? So addressing kind of pricing issues is kind of fundamental. And on the opportunistic side, when I was running JPS, one of the first things I did is went in, I said, okay, guys, tell me how many of the orders in our backlog are we going to lose if we raise prices 10%? Guys look around each other. None? Oh, really? What if we raise prices 20%? No. We just don't want to do that. I said, well, wait a minute. By the way, we're selling black boxes that are $25,000 to $100,000, and those boxes were competing against systems that were multi-million-dollar systems. We could have doubled the price, and it wouldn't have changed, honestly, the demand. It was a cultural. It was a cultural challenge to overcome. But we did raise prices over time, and that obviously we used those dollars to reinvest to strengthen the company and take a little bit more home too at the same time. But you can go through. We go through the P&L and we look at expenses, we look at cost, and we look at what are the drivers. What's really impacting those? Whether it's supply chain or overhead cost, or there's different components in the balance, for example. But we do the same thing with the balance sheet. And what we find is we talked about the working capital cycle, but we also look at make-buy decisions. It's that return on invested capital. Are we trying to invest in something in our company that really we're not experts at, and there are other people and other businesses around us that have already made bigger investments that we could have greater capability and better performance? That's what we did with JPS. Our team wanted to do everything in-house. And I say, guys, we're okay at making printed circuit boards, and I happen, by the way, to come out of that industry. I said, we're pretty good at that, but we're not the best. I said, and for us to grow, we're going to have to make a large investment in a lot of equipment. That doesn't make sense because that's not a competitive differentiator for us. And there are a lot of people around us. So we shifted our manufacturing strategy to partner with several local contract manufacturers and have greater capacity, better quality, and we had less capital invested. So that was an example of a make-buy decision that in that situation made sense. May not make sense in every situation. So we go through an exercise to look at both the income statement and the balance sheet and begin to drill down with management teams to look at these things that are really potential levers. And so what we're trying to do, if I had to begin to try to sum this up, we're trying to shift the discussion with an investor or a buyer or a lender from a historical trailing 12 months adjusted EBITDA, and we're going to, by the way, you're always going to have that, but we're trying to shift the conversation from that historical perspective to a future-looking perspective. And if we can take baby steps on our own nickel, and what I mean by that is if, as with JPS, we started managing and creating extra cash by managing inventory turns tighter, by managing the working capital cycle tighter, by raising prices, we were able to reinvest and to begin to shift and shift our value forward by doing things that were going to be considered forward-looking or value-creating activities. And what we did in the JPS example is we got ourselves to this premium value, which is kind of moving to the right, and positioned for this what I call breakout strategy. So let me tell you about our breakout strategy to try to round out the story. We were selling these black boxes for $25,000 to $100,000, and the market opportunity for us was to sell $1 to $5 million systems to the states. So we wanted the value of the company to be based on the value of those $1 to $5 million systems and that market opportunity, which would really get us to $100 million in revenue very quickly. So I could talk about it all day long, but nobody's going to pay for that, right? I'm not going to get any value for that. But what we did is we went through these first couple of steps of improving the operations of the business, reinvesting and putting some systems in, getting the right team in place, and then we went out and we said, we have to prove that that market exists and that we can sell this. So we went in our backyard and we knocked on the state of North Carolina and said, you guys need one of these systems. And we worked to sell one of these $3 million systems into the state of North Carolina to prove. And then we built a pipeline of all the other opportunities in other states, and we went then to the market to sell the business with a proven model and a pipeline. And that gave us a big jump in valuation, as you can imagine. Did we get it all in cash at closing? No. Did we have an earnout component? Absolutely. But the cash at closing was more than we would have gotten without it, and the upside was significant for the shareholders. The last part, you see 3 levers on the front of the book. There's a third lever, and you don't want to forget this third lever. The third lever is basically the idea of getting your house in order. I call it taking the friction out of the transaction process. So what do I mean by that? Good financial information. Do I have any CPAs in here? Probably do. You've got to have financial statements to GAAP, reviewed or audited, if we're going to do a transaction. But you can do it without it, but it's all about credibility. It's about speaking the language that the rest of the world speaks. And I'm not talking about modified cash or accrual accounting for taxes. If we're going to deal with valuation and deal with M&A transactions with larger buyers or with private equity, we really need to have a solid set of numbers. The stronger your financials, the more confidence that the buyer or investor has, the greater the negotiating leverage with those numbers. Otherwise, they're always hedging because they're not exactly sure what's not in those numbers or what is in those numbers. Assignability of contracts and change of control provisions. We see this all the time, particularly in businesses that are contract heavy, where they haven't really given any thought to that and they're not prepared for a transaction. It can be limiting depending on the type of transaction that you're going to be potentially attempting to do. Title to assets, I know this sounds a little crazy. You say, well, that's pretty easy, isn't it? Well, not if you have a lot of intellectual property and you haven't had the right agreements in place with those that developed the IP for you. And then part of what you're trying to pitch is that you have great competitive position and you've got a secret sauce that nobody else can have access to. It takes time and dollars to clean up IP issues, particularly with employees or contractors, if you haven't done it in advance. The other things that I won't spend much time on, corporate structure, talk about entity structure, S Corp, C Corp, how you're positioned, those type things. But what we're all trying to get at is optimizing that after-tax cash in a transaction. And so that to us is kind of the key. So it's not just price. What we try to drive toward, and we think that in the market is critical to drive for, is optimizing the after-tax cash. That's what you can take home, at least from a sales side. And knowing that on the buy side is equally as powerful because you're able to help the seller maybe achieve what the seller wants and at a reduced cost to you as the buyer. So a lot of the reasons that this is relevant. I would say that one of the key things here is timing. As you can tell, many of these things we're talking about take time, and the process of raising money, selling or buying companies is always a distraction for a management team. And so if you don't have a team that operates well and is functional to begin with, this only adds dysfunction to the process. So we're a big advocate of being prepared, planning and preparing in advance, and having your team plan and prepare. So try to wrap up a little bit, just kind of some key points here, if you will, for takeaways. Just think about those fundamentals and try to frame. One of the things we're trying to do is I've thrown a bunch of stuff at you to think about. The key is sorting through and figuring out what I call the real levers. It's the ones that can really have an impact on the realizable value and that you can focus on. So if you went through this, you'd say, wow, there's a lot of stuff to work on. Part of the idea is we've got to narrow it down to a very short list to focus on because we know that we can't do many. I think being able to demonstrate performance is kind of a second big concept here, is being able to talk about a strategy or talk about a growth plan is nice, but demonstration and execution is where you can actually see the value show up in a transaction. And then kind of keeping in mind this core concept, I go back to it, there's all kinds of valuation metrics for different companies, but at the end of the day, it really all boils down to long-term future cash flow. So that tends to be how we see the world.